let's get started on chapter 4. So you see, I've got a bunch of stuff up here on the board, which you are welcome to copy down. Also, just to kind of let you know, it's also here in the agenda, but sometimes it's easier to remember stuff when you actually write it down. This is what we're going to be going through today. So this chapter, again, I kind of gave you a little preview on Tuesday. Went through the objectives, and we're going to be calculating federal income tax withholding now in this chapter. So a little bit different from what we did with Social Security and Medicare tax withholding, but the basic equation is kind of the same. So we still have a base that we're going to work with. We have to determine what our rate is to determine what our tax then is. Now what we're doing is this calculation is on a per payroll basis, and each payroll can be different, right? If you're getting paid on an hourly basis, if you work 38 hours one pay period and then you work 42 hours the next pay period, that's going to change your base, right? Because one pay period you're getting some overtime and the other pay period you're not, and the hours are different. So, or we could be paid on a salaried basis, and maybe for each individual employee it's going to be the same. If they're paid, $2,000 every pay period, then that base is not really going to vary too much unless they get a bonus in one pay period or something special happens. The rate, however, and we're not going to talk about how we calculate the rate yet. We'll say that we'll start talking about that next week. But the rate is a little bit more complicated and complex with regard to calculating it for income tax purposes, for federal income tax withholding. So again, it's going to be calculated every pay period, but it's individualized. Like before with Social Security and Medicare tax, we just have that one rate, right? It's 6.2% or it's 1.45%, or if you're subject to additional Medicare tax, it's that 0.9%, but that rate doesn't change. The base may change, but the rate doesn't change each pay period, what we're going to apply to it. However, for federal income tax withholding, it's individualized because it's based on a lot of different individual factors. Things like, what's your filing status? Are you married, filing jointly? Are you single? Are you head of household? Do you have any dependents that you're going to be claiming on your tax return? How frequently are you paid? So there are a lot of different factors that go into determining what that rate is going to be. So what we're going to do today, though, is we're going to focus on figuring out the base for federal income tax withholding. In many cases, it's the same as the base for Social Security taxes and for Medicare taxes, but sometimes it's a little bit different. So that's what we're going to really focus on today. We're also going to look at we're going to spend a lot of time talking about fringe benefits. So fringe benefits are things that something other than cash that is being received by the employee in exchange for their work. Things like health insurance, or life insurance, or gym memberships. All those items that employers will use to incentivize employees, that is something other than their regular wages, right? And a lot of times these fringe benefits are used to try and attract certain types of employees, or maybe attract a higher caliber of employee. And they can get quite creative. The fringe benefits can get quite creative. But the particular types of fringe benefits, how they're treated for tax purposes, varies. Okay, and that's what we're going to go through here today. So let's start out. Well, first off, I want to. I'm sorry. I'm thinking ahead of myself here. So that whole employer-employee relationship still has to exist, right? So we're not going to withhold income taxes, federal income taxes, on individuals who are not employees. They have to be considered an employee, and it's the same factors that we used before, that 6-factor test of, who has control and who has the financial risk and everything that we went through in chapters 2 and 3. So same sort of relationship has to exist. There is a special type of category of well, they call them statutory non-employees, and I just kind of mentioned this as an aside. You don't really have to know a whole lot about this. Individuals who are direct sellers and certain real estate agents fall into this kind of no man's land between employee and independent contractor. For those individuals, there is no federal income taxes withheld, even though they may, in some instances, appear to be employees. We still don't withhold federal income taxes for them. So we're not talking about those people. We're talking about kind of everybody else who is an employee. All right. So recall, and we've gone through all of these items up to the taxable fringe benefits. These are the types of payments that would be included in our base every pay period that we would then use in the calculation of withholding, federal income tax withholding. So wages and salaries, obviously, whether you're paid hourly or on a salary basis, that would be included. Vacation, so if you took vacation time and you got paid vacation during the pay period, that would be included for purposes of calculating the withholding. Any type of supplemental payments, extra payments, like you get that safety bonus or stuff like that, which kind of overlaps here with the bonuses and commissions. But any one-time bonuses or repeat bonuses, that would also be included in our base. Again, we're just talking about the base right now. Would be included in our base for purposes of this calculation. Commission, so if you earn sales commissions, that would also be included. Tips. So, and we'll talk specifically about tips and how they're reported, but those taxable tips would also be included in that base for these purposes. Cash awards, I don't know how that would be really any different from the bonuses and commissions, but that would include like gift certificates, so like a Christmas bonus or yeah.
So what you're saying is this is what you are required to pay tax.
Yep. This is what the employee, this is everything that's going to be included in our base on a per pay basis before we do the calculation of income tax withholding. So remember, our equation that we're using, our base times our rate equals our tax. And so it just, in this today, all we're talking about is how do we determine what that base is? That's one of the factors that we need to know. How do we determine what's included in that before we can calculate how much income tax we have to withhold, right? So we're going to talk about all the things that are included in that and all the things that are excluded from that as well, because there are certain types of fringe benefits, if they're paid by the employee, that would reduce the base. Okay, so all of these things are included in that base. And actually, everything that's paid to an employee is included in that unless it's specifically excluded. Okay, and that's pretty much the same for everything tax-wise. All income is taxable unless they specifically say it's not, right? Unless there's some specific exclusion. And then we've got this category of taxable fringe benefits. And notice they say taxable. So we have two categories of, well, kind of 4 categories of fringe benefits. We have fringe benefits that are paid by the employer. So the employer pays on the employee's behalf, these fringe benefits over here on the left. So things like I mentioned, so health insurance. The employer pays health insurance on behalf of the employee. That's a common fringe benefit that employers will pay. The employee then doesn't, maybe the employee pays some portion of it, or maybe they don't have to pay any of it, but the employer pays it on the employee's behalf. That's a type of fringe benefit. It may be taxable to the employee. It may not be taxable to the employee. Things like Gym memberships. Some employers offer gym memberships to employees. So they'll pay for, if you join a fitness center, they'll pay all or part of your membership fee. Again, it's something to incentivize employees to stay healthy and try and encourage them. Ideally, a healthier workforce would then cost less as far as health insurance premiums go that the employer is providing. Also helps just with standard of living and all of that. So gym memberships. If the employer pays for a gym membership on behalf of the employee, that might be taxable. It might be non-taxable. But everything over here on the left, we're talking about things that the employer pays for. So the employer's writing the check. The employer is sending, yep. So it's not something that's coming out of the employee's paycheck on this side of the table. Yeah. FMV, fair market value. We'll get into what that means. That means that's fair market value, and we'll get into that. Over here on the right are fringe benefits that the employee pays for. The employer offers them. The employee can take them or not. They may choose to participate in them or not. Health insurance may come over here on the right side of the table. So if the employer offers a group health insurance plan, but maybe the employee has to pay all or part of that premium, that would then be an employee-paid fringe benefit. Some of those employee-paid fringe benefits are post-tax, some are pre-tax. What that means, if it's post-tax, it means you're not going to get any tax benefit. You're paying the money out, but it's not going to reduce your base for purposes of the tax calculation. So you've got the opportunity to take part in this fringe benefit. That might be a great thing, but it's not going to help you tax-wise, right? It's not going to reduce your taxes at all. There are some employee-paid fringe benefits, however, and actually health insurance is an example, that most times the health insurance, if it's paid in whole or in part by the employee, most times it's pre-tax, which means it will reduce the base. So the value of that benefit will reduce the tax base, which results in a tax benefit to the employee. So they're going to pay less tax. Everything down here at the bottom means the employee is getting some sort of benefit and they're not having to pay tax on it. The stuff at the top, the employee is still getting a benefit, but it's not affecting their taxes. That's not going to have any effect on their taxes. So these items here were all cash. They're money that the employee has earned, right? The taxable fringe benefits are a separate category, again, used to incentivize employees over and above just the cash payments. There's no requirement that employers provide any fringe benefits. Certain governmental entities are required to provide certain fringe benefits. Just by statute, they have to do that. But private companies are not required to provide them, but many of them do, especially if they're jobs where they're not really jobs, but they're more careers. They're long-term careers. A lot of times employers will provide those. All right, so some other examples of taxable payments to employees, and some of these I'm going to go into a little bit more detail about than others. The drawing account advances. This is a kind of a special category that applies to sales people who are in the sales business. A lot of times, I don't know how common it is, but sometimes individuals who are in sales, essentially all of their salary is from commission. Like 100% of what they make has to come from commission. But the employer is required to pay them a certain amount every pay period. And what happens, it's kind of a continuous ledger of account that if you don't meet your commissions for the month, the employer still has to pay you maybe that $2,000 or whatever the minimum is. They still have to pay you that $2,000, but you didn't earn $2,000 in commission. Well, the employer still has to pay the $2,000, but now let's say you made $1,800 in commission, but they have to pay you $2,000. You've got $200 that you've got to make up. So they're going to pay you the $2,000, but that $200 is going to go then apply to the next month that you're going to have to make additional commissions. So it's kind of just a running ledger. So that's what they're referring to here. So drawing account advances. So even if you earned $1,800, if they paid you $2,000, that's what you're going to pay the tax on. It's like an advance. That $200 was like an advance. You're going to pay tax on it. It gets made up in future months. So that's what they're referring to here. Gift certificates are considered a cash equivalent. So it's like they're giving you, so if your employer gives you a $100 Amazon gift certificate, maybe it's a bonus or just a thank you, that's still considered to be, the value of that gift certificate is considered to be wages and would be taxable then in the period that it was gifted. So it's taxable. Meals and lodging, we've already gone through this. If it's for the employer's convenience, it's not taxable. So yeah, I suppose you could call that, yeah. So it would be one of those employer paid fringe benefits. So the employer is bearing the cost of that meals or lodging, but because it's for their convenience, it would not be taxable to the employee. If it's for the employee's convenience, so the employee is the one that you know, they could take it or leave it, they're choosing to take that benefit, that would be taxable then. The value, the fair market value, and again, I'll go through that a little bit more here in a bit, but the taxable amount then, or the amount of that meals and lodging would be taxable. So the meals and lodging could be either of these depending upon whose convenience it's for. Right? Who it's mostly benefiting in that case. Moving expenses. So if an employer reimburses you for moving expenses or pays you for moving expenses, so this is the case where maybe your current employer wants you to transfer to a new location. So you work for Principal, you're working in Des Moines, they want you to work in Denver. They want you to go to the Denver office, which means you're going to have to pack everything up. Maybe you're going to have to sell your home. You're going to have to bear all that expense of getting everything out to Denver and all the moving that's associated with that and all the expense that's associated with that. If the employer reimburses for that, that is taxable to the employee. This is something that actually changed in 2017. It used to be that was not taxable to the employee. And this is a big deal because moving expenses can be quite hefty. You know, we're talking tens of thousands of dollars that can be then added as taxable income to the employee. So now they have to pay, even though they didn't get the cash, you know, they bore the expense. Either the employer paid on their behalf or they had the expense and they were reimbursed for it. So they're not really any better off. They just moved from one place to the other and had all that expense. But the value of that expense is taxable to the employee. That's one of those areas that surprises a lot of people because, like I said, it used to be, before 2017, that was not the case. Moving expenses were not taxable to the employee. And they wouldn't have to, they wouldn't have to include that in their taxable income. But now they are taxable. One exception is active members of the armed forces. So if you're moved around because you're part of the military and you're on active duty, that is not considered taxable income. But for everybody else, for all the rest of us chumps, it is considered taxable. So, and I mean, that would include like if you get your first job out of college and they pay for your moving expenses. Maybe you're going to go to Chicago and work for an accounting firm. They pay for your expenses to get out there. That's taxable income. So even though you didn't get the cash, you're going to have to come up with the tax in order to pay that. I'm going to come back to this partially exempt employment part. Payments to non-resident aliens, still taxable. Your status as a resident or non-resident alien doesn't make any difference. Still subject to withholding. Scholarships. So individuals who receive scholarships, if they do not have to provide any services in exchange for that scholarship, maybe they took the SAT and they got a really great score and they got a scholarship. They don't have to do any teaching. They don't have to do any research. There's nothing they have to do in exchange for it. All they have to do is attend that institution. In that case, the scholarship is not taxable. It's not considered to be taxable income. The only time it would be considered taxable is if, say you got a $25,000 scholarship, but your actual expenses were $22,000. So then the additional $3,000, the difference, that would be taxable. But if you, in exchange for that scholarship, let's say you have to be a research assistant or a teaching assistant, you have to provide some sort of service to the college, now it's considered to be taxable income, because really it's earned income at that point. You're not getting cash, but instead you're getting education that has a value to it. Sick pay. So this is whether it's you take a sick day and you have a sick leave benefits with your employer and they pay for your day off. That obviously is still considered to be part of wages. So that would be taxable. Also for disability payments, that's what they're talking about here with the third party. So if you're on short-term or long-term disability, whether it's taxable or not depends on who paid the premium and whether at the time that the premium was paid, it was taxable or non-taxable. So if you haven't received any tax benefit from it in the past, then when you receive the benefit for disability payments, it's not taxable. If you received a tax benefit in the past, in the form of it was either pre-tax, you paid the premiums and it was pre-tax, or the employer paid the premiums and it was not taxable to you, in that case, it is taxable. So it kind of has this balance. If you didn't get a tax benefit in the past, then you'll get a tax benefit now in the form of it's not going to be taxable income to you. If you did get a tax benefit from it in the past, it will be taxable to you. So it kind of balances out there. So that's what they're talking about here. Partially exempt employment. This, what they're talking about is if you provide services to the employer as a W-2 employee and as a contractor, so you've got two different roles. If during any pay period you perform more, you spend more time as an employee, so 51% of your time as an employee, 49% of your time as a contractor, you're considered to be an employee for all of it. So it's the only time that they can divide that up is if the time spent as a contractor is actually more than the time spent as an employee. And that's on a per pay period basis. So that would mean that even if you performed duties as a contractor, if it was less than 50% of the time in a pay period, you now are subject to withholding on all of that money. But the employer also is going to have to pay your half of the Social Security and Medicare taxes and everything. So that's what they're talking about there with partially exempt. Unemployment compensation is taxable. It's replacing wages. So it is subject to withholding as well. That unemployment compensation would not come from an employer. It would come from a state agency. But it is it's taxable, subject to withholding. Travel and business expenses. So for travel and business expenses, what we're talking about is if an employer either reimburses you for travel that you're doing on their behalf. So let's say they want to send you to a conference, right? You got to go to a conference in Orlando and they're going to pay your expenses to get down there, or you have to pay it and they reimburse you for the expense. If it's part of what's called an accountable plan, and one of the slides goes a little bit more detail about what an accountable plan is. It's really just a piece of paper that's a contract that tells what the employer is going to reimburse for. It's not something that gets sent into anywhere. It's just something the employer has on file. But if it's part of an accountable plan, then the reimbursements or the payments on the employee's behalf are not taxable to them. So they can send you off to that conference and they can reimburse you for the flight that you paid for. They can reimburse you for your hotel and all of that, and it's not going to be taxable to the employee. If there is no accountable plan on file, however, then that becomes taxable income. So you went to a conference on their behalf, spent $2,000, you got reimbursed for the $2,000. Now that $2,000 is considered to be taxable income to you because it was part of a non-accountable plan. Actually, when I was practicing, I put these accountable plans together for employers because they're super easy. You can just Google, get a template. It's an easy thing to do for employers to set up. But there's a distinction there between the accountable and the non-accountable plan with whether or not those travel expenses become taxable or not to the employee. That would also apply to like mileage reimbursement as well. So if you're, I used the example in the last class. So my husband does a lot of travel for his work. He's driving all over the state all the time. So at the end of every month, he submits for mileage reimbursement, which is to take care of the expense of the wear and tear on his car. He pays for the gas, he pays for all the repairs, he has to pay for all of that maintenance, but he gets a per mile reimbursement then at the end of the month. Because they have an accountable plan, that mileage is not taxable to him. So he gets a check at the end of the month to take care of that, and it's not taxable, not added to taxable income. There's no withholding on it. If they didn't have an accountable plan, then that check would have to be withholding on those payments. Yeah.
If you were to start a job, would it be okay for you to ask the employer to write up an accountable plan?
Yeah, most larger employers, they will have it. It's the small ones that sometimes they don't realize that they need to have that. But yes, if you're like applying at a small business and there are expenses that they're going to expect you, that they say, you're going to have to pay this, but we'll reimburse you for it. It would be appropriate to say, okay, I just want to make sure that's not taxable to me, that you've got an accountable plan on file, and that, that would be, and a lot of small businesses don't realize it. They don't realize that there's this distinction. Now, obviously, it's only going to come up if the IRS starts to ask questions of the business. But it is technically something that they need to have in place. And all it does is it says, we will reimburse for these specific, they do have to say which expenses they're going to reimburse for, right? Maybe if you have a home business office, they'll reimburse for some of your home expenses. So it's just a super simple thing to put together, but it's one of those areas that a lot of small businesses really aren't aware of. So these are things that are taxable, okay? Now, let's move on to talking a little bit about some of these fringe benefits. And we're going to talk about both taxable and non-taxable. Now, like I said, these are, on this chart here, I've got employer-paid fringe benefits. So the employer is the one that's writing the check for it. And then I have employee-paid fringe benefits. So these are things that the employee is paying for the cost of it themselves. And again, these items may provide no tax benefit to the employee, or they may provide a tax benefit to the employee. So subject to income tax withholding unless it's specifically excluded. So there has to be a specific exclusion for the fringe benefit for it to be pre-tax or non-taxable. Otherwise, it's going to be not provide any tax benefit. Equals the fair market value of the benefits minus any payment made by the employee. Most times this is pretty easy to determine. So that's what this FMV means, fair market value. So the fair market value in this case, if it's a taxable fringe benefit that was paid by the employer, we're going to add the fair market value to the taxable wages to our base before we calculate what the withholding is. That means it's going to increase our base, essentially. The fair market value is whatever, like I said, in most cases, it's easy to determine. Like that gym membership that I talked about, it's whatever the cost of that gym membership is. So whatever the employer paid, that's the fair market value of it. Other items are a little bit more difficult to determine. Some of them have standard rates. Like the mileage, like I mentioned, the mileage has a standard rate. But most of them are pretty readily available. We're going to go through some different fringe benefits as well. We've got a whole list of them that we can go through. Some of them that are non-taxable, items that would not then be otherwise known as exempt, not be added to the tax base before we calculate that withholding. Services provided at no additional cost. So these are things, an example, and I think your book may use this example, airline seats. So if you work for an airline and they have an empty seat on a flight and they offer it to employees, well, there's no additional cost for them to have somebody sitting in that seat, right? I mean, maybe there's a 50 cents more in fuel that they're going to pay, but it's negligible, right? So if there's no additional cost to the employer, then any service that they provide is not taxable. So example, maybe if you work for a CPA firm and they allow you to prepare your taxes. And most CPA firms, if they're doing a lot of taxes, they buy a package of, so they get all of their tax returns included for one flat fee. It's usually a ridiculous fee, but it's one flat fee, depending upon how many returns they do. But if employees get to prepare their own taxes. So there's no additional cost for the employee to sit there and enter it on their software and then submit the tax return, right? So in that case, it would be a service that the employer is providing. It didn't cost them anything extra, right? So that would not be taxable. Qualified employee discounts. Now, qualified, I think there's a threshold of 20%. Was the last I knew, it was 20%. If you work for an employer, say you work for, I don't know, the Gap. Do they exist anymore? The Gap? Yeah. Okay. So and you can buy clothes as an employee and you get a 20% discount. That discount's not taxable to you. But if it's more than 20%, and I'm pretty sure it's 20%, if it's more than that threshold, then the additional amount of discount would technically be taxable. Okay, so
is that automatically calculated for you?
Well, it's up to the employer to calculate that. Yep, yep. So, but that, yeah, so qualified employee discounts are not taxable. Use of on-premises athletic facilities. So I mentioned the gym membership earlier, and in that example, what I was talking about was, the employer pays, whatever the fee is per month, say $50 a month for you to join a gym, and they pay it on your behalf, but that gym is not on the premises. In that case, that scenario, that is a taxable benefit. So the value of that $50 every month is taxable to the employee because the gym is not on the premises. If it's on the premises, like here, DMAC has Trail Point, there's a gym on the premises. So employees are allowed to use that gym. You can become a member of that gym. It doesn't cost you anything. And it's not, the value of it is not added to the tax base for purposes of withholding. So it doesn't, there's no cost to the employee to do that. But if it's off premises, then it becomes taxable. So those on-premises athletic facilities, reduced tuition for education. Employers can pay up to $5,250 a year on behalf of their employees, for the employees to attend higher education courses. So they can pay for, and a lot of employers provide this. They will, the bigger employers, to help, employees to enhance their skills or gain, maybe you've got a bachelor's degree and they want you to get a master's degree. They'll help pay for your master's degree. Up to $5,250 a year of that tuition is not taxable to the employee. If they pay $6,000 a year toward tuition for the employee, the first $5,250 are not taxable, but the $750 extra would be then added to the tax base of the employee and would be subject to withholding and would be taxable. Okay. Working condition fringes, that's stuff like little stuff like, oh, we've got coffee available in the break room for you, or we've got bottles of water available in the break room, that kind of thing. Any working condition fringes. Also, parking on the premises. So, I mean, obviously in DMAC the parking situation is kind of a nightmare, but there's no charge for the parking here at DMAC. So the value, you don't have to add the fair market value of that parking to employees' paychecks. There is a complete list, and I want to point this out to you. Circular E, I've got one of them up here, Pub 15. So this one's for 2025. The one, and the link, well, let me show you where the link is. There's a link to this publication in Canvas. Under the Chapter 4 module, the articles and web links, I've got, more here. Actually, I've got the old one, 2023. Let's see what it actually I got to update those. Oh, it does go to 2023. I'll update those. They need to be for 2024, so I will update those links for you. But this, let's see, that's the 15T. Okay, this document, Circular E, so obviously they put out a new one of these every year because the rules change every year and the thresholds change every year and all that. But this form, this Circular E is kind of like our whole payroll class in one publication. So you can see some of the topics we've already talked about that are in here. Who are employees? So if you want to kind of read about it in a different manner, you can go to this publication and take a look. If you want some more information about it, like the IRS has publications on absolutely everything, every tax topic. And they're great places to go to further understand the rules, the different rules. So wages and other compensation, what are considered to be wages and other types of compensation. Tips, if you want some more experience and more insight on how those tips are calculated, how that tip income is calculated. Supplemental wages, payroll periods, so it goes through biweekly, semi-monthly, monthly, those different payroll periods. Withholding from employee wages. So there's a section here about how withholding, depositing taxes. So that whole schedule, deposit schedule, that's in here as well. But payroll period, not payroll period, that's not what I wanted. Go back up. I wanted withholding. So there's information in here about the payroll period, the withholding, everything that I'm talking about here. Exemption from federal income tax withholding. There are some employees that can claim an exemption, so none of their wages are subject to withholding. The income level, though, is very low for them to be able to claim that. Let's see. Supplemental wage payments, so I'm going to talk a little bit about that. What else? All sorts of stuff. There's information here about Social Security and Medicare taxes. So this Circular E, that's what they're talking about here, is there's a complete list of non-taxable fringe benefits that are listed in that publication. There's another publication that I have on here, and we'll look at this in more detail when we get to the calculations of withholding. This has those different methods for calculating withholding listed here in this publication. This is the publication 15T. So this is another one. And you can Google 2024 Pub 15T and you'll find it, but I'll also include the links, the updated links. Sorry, apparently didn't get to that. And then I've also got information about Iowa. I'll update this as well for 2024. Actually, for Iowa, I'll probably give you the 2025 information since we don't have anything in the book specifically about Iowa. That's more just supplemental information for you. I'll include the 2025 information there because that's more current. Let's see. Any questions so far? All right. So we know that there are certain fringe benefits that the value of them, the fair market value, has to be added then to the wages for that pay period, and then we calculate the federal income tax withholding. So how do we do that? There are a couple of different ways that we can do this. We can include the amounts with the wages. So let's just say we've got wages this period of $2,000. Whoops, I don't need three of those. $2,000, and then we have a taxable fringe of $200. So what this does is it makes our base $2,200. Even though their gross wages, the gross pay was $2,000, we have to add this $200 because they've got a taxable fringe benefit that they have to pay tax on. So we can add it to our base and go through the calculations the normal way, just as though they were paid $2,200. The other thing that we can do is we can tax this $200 separately. If we tax it separately, what we have to do is use a flat tax rate. So we use a 22% flat tax rate, and this works well like if it's a bonus. You can do this with bonuses as well. So if you pay a bonus, you can pay it separately, tax the bonus at just a flat 22%, or you can include it and it will apply, then the tax rate that applies to the entire pay will be what is used. So you can tax it at the flat. If you're paying it separately, or if you're calculating it separately, you tax it at a flat 22%. I think we talked about this with bonuses too. Like bonuses, it's 22% unless the bonus, if you're lucky enough to get $1 million bonus, then it's at 37%. Or you can add the value of those fringe benefits to the regular wages. So those are the two ways that it can be done. Also, there's flexible reporting of this. So for example, they've got an employee here who gets a country club membership. So the employer pays for their country club membership of $2,000. The employer could tax that $2,000, tack it on to one of the pays, and so now instead of a $2,000 pay, if it's the country club membership, we're going to add all $2,000. And now their base for this pay is $4,000. What that usually does is it bumps them up into a higher tax bracket. They're going to pay a higher rate on that full amount of pay. The other thing that they could do is they could spread it out. They could spread it out. In this example, they spread it out over 4 different pay periods. So $500 for 4 different pay periods. Now their taxable base is going to be $2,500. Maybe it doesn't bump them up into a higher tax bracket. It doesn't bump them up. Remember, so the rate is based on, one of the factors that the rate is based on is how much you're being paid. And as I had mentioned, we have a progressive tax system. The more you make, the more they take. So the higher this number is, the higher that rate is also going to be. So if you could choose between, okay, I'm going to add all of it in one pay, or I'm going to spread it out, chances are you're going to keep that rate down if you can spread it out. Okay, so you got the option, the employer has the option to spread out those taxable fringe benefits over several periods. They want to do that. Okay. So, tips. This would be, I mean, obviously this is not fringe benefits. We kind of moved away from fringe benefits. I will talk a little bit more about this after I go through the rest of the slides. How the federal withholding works with tips. If the employee is reporting actual tips that they received, there are 2 ways to report tips. One is you report what you actually received to your employer, The other is that the employer allocates tips, which is essentially just an assumption of how much you made in tips. And that assumption is going to be based on either the number of hours that you worked, the gross receipts, so how much you made in sales. So that makes actually more sense to use gross receipts if it's a profession like wait staff. So they would assume maybe 7% tips on all of your gross receipts for the month. So if you had $10,000 of gross receipts for the month, the assumption is that you made, was that $700 in tips over the course of the month. Those are allocated tips. Establishments with more than 10 employees have to use the allocated tips. If, however, you're reporting actual tips, so they're not allocating them, but it's actual tips, so you made $800 in tips during the month, you have to report those, the employee has to report those to the employer by the 10th of the following month. So if you made $800 in tips during the month of October, by the 10th of November, you report that to the employer, and then the employer is going to withhold on those tips. So they're going to add the amount that they pay you, their wages that they owe you, plus that $800, and that's what the employee is going to be taxed on. That's the tax base that's going to be used. And there is going to be withholding on it. If it's allocated tips, though, those allocated tips are not subject to withholding. So there's no withholding on it. The employee still has to pay tax on it, but the employer doesn't have to withhold on them. So that's how the reporting on tips works. Okay. All right, travel expenses. I already talked about this, really. This is just affirming that difference between the accountable plan and the non-accountable plan. Accountable plans, again, and maybe I can pull one up so we can take a look at what it looks like. There, accountable plan template. So, let's see. Oh, is it gonna? Of course, I can't really see it, can I? And it's blurry. Let's see if I can find one that's actually readable. Let's not use a template. Let's just talk about accountable plan. So I guess this is just a partial kind of a, oh, they're not going to let me in though, because this is Thomson Reuters. They want me to pay for a subscription. So it outlines how they're going to reimburse expenses. So any individual employed by this company will be reimbursed for ordinary necessary business and professional expenses incurred on behalf of the company, provided that the expenses are adequately substantiated in accordance with the company's policy. So that is one of the requirements as well. So there has to be, receipts have to be kept. So the employees, in order to get reimbursement, they have to provide receipts. So that's one of the requirements of an accountable plan. Under no circumstances will this company reimburse employees for expenses that are not properly substantiated, what the timeline is for that substantiation, yada, yada. So it just indicates the types of expenses that they'll reimburse for, how that reimbursement is going to happen, or what type of documentation is required. Like I said, these are super simple. Let's see if this one is any here. So employees must provide receipts for any expenses. Now they've got a threshold of $75. So it just something as simple as that, a one-page document that outlines what that is. And that then essentially protects the employer and the employee. If it's all the travel expenses or any expenses that are reimbursed, if they're part of an accountable plan, then it's not taxable to the employee. Otherwise, if there's no accountable plan, the employer is required to withhold income tax as though it was. So what it does is it moves it from a non-taxable fringe benefit into a taxable fringe benefit, okay, which is not good. Let's see, payments exempt from withholding. So we're going to go through, we've got a whole list of things that are exempt. And I'm not going to go through each one of these things. I'm going to go through a few of them, though. I'm going to pick and choose a few of them here. So advances for travel. So if your employer gives you $5,000 and says, I'm going to send you to Orlando for 2 weeks to attend this seminar, and this is to cover all of your expenses, as long as you spend the whole $5,000, or the employee repays any amount that's not spent, then it would be non-taxable. So that would be excluded. Again, there has to be an accountable plan. If, however, the employer says, here's $5,000, you can keep whatever's left over, then the amount that's left over becomes taxable income, right? So because it's not for travel expenses, it's no longer a reimbursement, it's a payment, okay? So that would be an advance, so where the employee pays and then, the employer pays the employee and then the employee incurs the expenses. Dependent care assistance, so to the extent that it's reasonable to believe that these amounts of, I don't know why they say that, up to $5,000 will be excluded from an employee's gross income without being subject to Social Security, Medicare, and income tax withholding. So what they're talking about here with dependent care assistance, this could be a non-taxable employer-paid benefit, or it could be a pre-tax employee-paid benefit. This is where either the employer sets aside money for the employee to use to pay dependent care expenses, child care expenses usually, or the employee sets aside money from each paycheck to then reimburse themselves for dependent care expenses. So how that works is the employee, they will pay the daycare center. They have a receipt from the daycare center. They paid $500. They submit it to this separate savings account where they'll get reimbursed that $500. That $500 is now not taxable to them. So it's a great benefit. It's also excluded from Social Security and Medicare tax. Let's see, what else do I want to we already talked about the educational expenses. We talked about employee business expense reimbursements and those accountable plans. Employer provided parking. So this is where, separate from DMAC, because there's no charge for parking here, but if you work for an employer, say you work in a downtown metro area and you have to pay for the parking garage, and maybe there's a monthly fee, the employer can reimburse you up to $315 a month for that parking, and it is not taxable. Same thing with public transportation. So if you live in a metro area where there's light rail and you get a monthly pass for light rail, the employer can pay for that and reimburse you up to $315 a month, and it would not be taxable to the employee in that case. Let's see. What else do I want to mention here? Talked about moving expenses. Okay, retirement and pension plans. Employer contributions, so again, this is employer paid, contributions to a retirement plan are non-taxable. So the employer, now there are limits to how much they can contribute, and those limits change every year. And those limits are dependent on the type of retirement plan. But if the employer contributes to a retirement plan on behalf of an employee, that contribution is not taxable to the employee. Because what's going to happen is when they retire, they're going to draw from that account, and then it's going to be taxable to them. So it's not that it's never taxable to them, but it is not taxable to them at the point that the contribution is made. And that's for all different types of retirement accounts where the employer is making a contribution. Now, employees will also oftentimes make contributions. Sometimes there's like a match. If like a 401k match, employer says if you contribute 10% of your income to a 401k, we're also going to match it and contribute 10% of your income. In that case, we've got both a pre-tax component and a non-taxable component. The employer paid portion of that is non-taxable. The pre-tax portion is the amount that the employee pays. So that means it's going to be subtracted from their wages. So if we've got an example here, so we've got wages of $2,000 and we've got a pre-tax, we'll say it's a 401k, which is a type of retirement plan contribution. So if the employer is contributing, it's non-taxable, so any amount would not be added to this wage base, and any amount of contribution that the employee makes is going to be subtracted from the wage base. And now the wage base is lowered. Wage base is lowered, reduces our base, reduces our tax. We get a tax benefit from that. Now suddenly $200 of our income is no longer taxable. Right? If you didn't make that contribution, the full $2,000 would be the taxable portion. Whereas now with that contribution, $1,800 of it is taxable. And so, like I said, that is for any different type of, and here they're really talking about employer contributions, elective contributions, and deferrals containing qualified cash or deferred compensation arrangements. So this is the elective contributions are the amounts that the employee would make. So there's a difference here. Again, employer portion and employee portion, non-taxable pre-tax. I was going to say something else. That's why I'm kind of rambling here, and I can't remember what it was. Important, because you've got some homework problems around this. Retirement and pension plan contributions that are made by employees, so those voluntary contributions that the employee makes, are pre-tax for income tax purposes. So when you're calculating federal income tax, and in Iowa state income tax as well, you'd get to reduce it by this. But they are not pre-tax for Social Security and Medicare tax purposes. So you have to do a separate calculation to determine how much your base is for federal income taxes versus how much it is for Social Security and Medicare tax purposes. So in this case, here's our base for federal income tax withholding, FITW, but our base for FICA is still the $2,000. So you get two different bases. That's only for pensions, for retirement benefits. For health insurance, it's pre-tax for both. For other types of benefits, health benefits, dental insurance, vision insurance, those dependent care plans that I was talking about, we're going to talk a little bit about health savings accounts and flex savings accounts. The base would be the same. This is just for retirement. There's a difference. So I mention it, I emphasize it because I know you've got a homework problem that involves that you have to, they'll throw this in and you've got to figure out what the net pay is, which means you're going to have to do two calculations, one for income tax purposes, one for Social Security and Medicare tax purposes. So it just adds a little bit of a wrinkle to it. What else? Oh, I already mentioned the commuter passes as well. Okay. There's a special kind of benefit called a cafeteria plan. With a cafeteria plan, it's kind of like, it's not like an accountable plan in that the accountable plan is really easy to set up. Cafeteria plans usually require an administrator, and that administrator, of course, is some third party that you have to pay to administer the plan. But the cafeteria plan allows employees to pick and choose benefits that they want to receive. Everything in a cafeteria plan has to do with health and wellness type of benefits. So accident and health insurance can be included in a cafeteria plan. Self-insured medical reimbursement plan, there are some employers that will instead of or in addition to offering health insurance, they'll reimburse for medical expenses, reimburse employees for medical expenses. So that can be part of a cafeteria plan. Group term life insurance, they mention here on the first $500,000 of coverage, that's the benefit. We're not talking about the premium, we're talking about the benefit. So if an employee dies and they receive more than $50,000, the family receives more than $50,000 in benefit, then the amount of the premium that applies to the extra benefit is taxable. But if it's limited to only a $50,000 payout benefit for life insurance, then the premiums are not taxable. Dependent care assistance, we talked about that, where employees can set aside, divert money from their paycheck into a savings account that then can be used to pay for dependent care expenses. Health savings accounts, this is the same type of thing as the dependent care savings account, where employees can divert income from their paycheck into a specific savings account that then can be used to pay for medical expenses. You can't pay for health insurance premiums with it, but you can pay for like your co-pays or your deductibles or your prescriptions, your eyeglasses, all of that kind of stuff. So these health savings accounts, all of these types of benefits can fall under this cafeteria plan umbrella. And what happens is, if it's in a cafeteria plan, it makes the benefit pre-tax. Now, these are all things that employers may contribute to, but for the most part, there are amounts that employees will pay. Okay, so it makes it pre-tax. So like I said, health insurance is a great example. So you're paying toward health insurance. You've got your $2,000, get a different example up here. So you've got your $2,000 of wages. You pay $200 every paycheck for health insurance. Now your taxable base is $1,800. Because that health insurance is within a cafeteria plan, it then makes it pre-tax. Cafeteria plans, and I don't know the specifics of this, but employees can choose between a cash payment or the qualified non-taxable benefits. So there's supposed to be some sort of choice there between those two. Like I said, I don't know the specific details about that, but and how that exactly works. Contribution to flex spending accounts. So these flex spending accounts, that is another type of medical savings account, but it's different from an HSA in that it's different from a health savings account, in that the health savings accounts, you can contribute more to them every year. I think it's like $8,000 if you have a family plan, but the health savings account, you have to have a particular type of health insurance in order to contribute to it. Also, with the health savings account, you contribute to it, the money never goes away. It's yours forever. Even if you don't have that type of insurance anymore, you can still draw from that plan. You can't contribute to it, but you can draw from it. If you get a different job, you can take it with you. It doesn't go away. A flex spending account is, again, it can be used for medical expenses, but the limit is lower. So in 2024, it was $3,200. I think 2025, it's $3,300 you can contribute. Next year, I think it goes up to $3,400, but you use it or lose it. So if you've taken, and a little bit is taken out each pay period, and so you have access, though, to the entire amount right from day one. So if you have, for example, let's say you put in the max of $3,200 and you get paid 24 times a year, so divided by 24, so every pay period, what does that come out to? So every pay period, you are diverting $133.33 into your flex account. Your wages, your taxable wages, are reduced by that amount. From day one, you have access to $3,200 that you can use for medical expenses. So you get to draw until that goes down to zero. But if you don't spend that whole $3,200 during the year, at the end of the year, I think you've got like about 3 months after the end of the year to spend it, the money reverts and your employer gets to keep that money. So like if you go through the year, you have this amount withheld, you got the tax benefit from it, but you only spent $2,000. You've given up $1,200 that you're never going to get back. So that's the difference between the flex accounts and the HSAs. So, and that's what they mean here. They're forfeited if it's not used. So it's use it or lose it. Already talked about the health savings accounts there. You've got to have a specific type of health insurance called a high deductible health plan. Those who have the high deductible health plan know they have it because it's oftentimes, it kind of marries with this health savings account. And it is just what it says. It's a high deductible. So it's got to have a deductible that's more than a certain amount. It has to meet particular guidelines. Already talked a little bit about the retirement contributions as well. Exempt from, so these are amounts that are paid by the employee. So again, employee paid fringe benefits. They are pre-tax for federal income tax purposes. They are not pre-tax for Social Security and Medicare tax purposes. They're all different types of retirement contributions. This one talks about IRAs, so employees can contribute separately to IRAs. Over and above the 401ks, they have to meet certain income guidelines in order to qualify for that. And there are a couple of different types of IRAs. A regular IRA, individual retirement account, that's contributed to is pre-tax. But when you take the money in retirement, you are taxed on that amount of distribution. There's also a type of IRA called a Roth that is post-tax, so you don't get any current benefit, but when you take the income in retirement, there is no tax on it. It's a wonderful thing. Ideally, if you have a lot of earnings in that Roth IRA, when you take it, it's non-taxable. Okay. So, does everybody understand this chart, this table? That we've got the employer side and the employee side. Some benefits that are paid by the employer, so they're writing the check, some benefits that are paid by the employer may be taxable to the employee. It's just like instead of giving you $50 in cash, I'm going to pay for a $50 gym membership. So it's taxable. Just because you didn't get it in cash doesn't mean you're not going to pay tax on it. But some special benefits are non-taxable. The retirement contributions. So instead of giving you $200 every paycheck additional, I'm going to put that $200 into a retirement account for you. Now, because I did that, it's non-taxable, simply because it's going into a retirement account. So there are some special classifications that are non-taxable to employees. And then over here on the right, we've got the employee paid benefits. These are amounts that the employee is having withheld from their paycheck. There are some that are post-tax, which means what we're going to do in the sequence of our calculation, we're going to subtract those benefits after we calculate the withholding. So we have $2,000 of wages. So like say so we've got our wages and this is our base. We don't have any subtractions. We have a federal income tax of $200. So that's after we've calculated what our federal income tax is, $1,800. And then we're going to subtract, so if it's a post-tax deduction, we're going to subtract the benefit at this point, after we've calculated our taxes. And this would also include Social Security and Medicare taxes, by the way. So let's just say we have a post-tax charitable contributions. Some employees you can contribute to like United Way, that's and they can take it right from their paycheck and make that contribution, but it's a post-tax contribution. Okay, so let's just say they contribute $50. So now their net pay, sorry, I know this is kind of a mess here. Their net pay is $1,750. This would be a post-tax deduction. A pre-tax deduction, what we're going to do is we'll take our wages, whoops, not negative wages, and if it's, let's say this deduction is pre-tax instead, we're going to subtract it before we calculate the taxes. So now our base, so before our base was $2,000. Now we're going to, let's see, 1950. Now we're going to calculate our federal income taxes based on the 1950 instead of the 200. So probably our federal income taxes are going to go down. Let's just say it goes down to 175 for our federal income taxes now. So what do we have here? 8,415. Can't do that in my head. 14, 1775. Okay, so now our net is 1775. So this is an example of how the net pay, what you actually receive, is more than what you would have received if it's a pre-tax deduction. Okay? That's the base. So when we're doing, before we even calculate that rate, before we can determine what that rate is, we've got to figure out what the base is. So we have to do those adjustments to it. Okay? We may be adding, we may be subtracting, we may be doing nothing. All right? All right, any questions?